This is Real Tax, Real Insights, straight talk from the EY Center for Tax Policy in Washington, D.C., where we cut through fast-moving tax developments to explain what they mean for your business. Today, we're focusing on energy tax policy and the One Big Beautiful Bill Act that was enacted into law last summer. What changes did it make to the clean energy tax credit framework established under the Inflation Reduction Act? What challenges are businesses facing right now, and what should they be doing next? Joining me today is Greg Matlock. Greg is EY's America's Tax Leader for the energy sector. Greg works with energy companies to strengthen their tax and finance functions, guiding smarter investment choices and more efficient, sustainable operations. Greg, it's great to have you here. Let's get started. First question, how did energy tax policy shift under the One Big Beautiful Bill Act, or OB3? Let's use OB3.
In many respects, energy policy is affected through the Internal Revenue Code, right? It's energy tax policy. And to understand how things have shifted, we first have to look at that legislative pivot between the IRA and OB3. While the IRA was focused on green energy from a policy perspective, OB3 is focused on domestic manufacturing, energy security, and energy independence. Where the IRA established long-term technology-neutral tax credits for things like clean electricity and focused on core renewable energy, OB3 is focused on different sources of energy that provide that energy security. And so while OB3 did scale back certain sunset dates, it did also provide some benefits to other types of tax credits.
So shifting from more targeted provisions to broader principles, broader scope. So let's make this real for business leaders. Like, who benefits most from the changes made by OB3?
Well, if we look back at the IRA, the focus sectors were around clean energy generation. Under OB3, the focus sectors, or the sectors that maybe benefit a little differentially under the new provisions, are those in that domestic manufacturing category, right? Because they are the ones who benefit from full expensing and R&D deductions becoming permanent. And also anything related to energy infrastructure and energy production, which spans the lifespan of oil and gas to metals and mining. It's really, and OB3 is really in line with an all of the above energy policy. OB3 also did a number of things from a non-tax perspective to encourage easier and more efficient permitting, right? How do we get this production that we know we have a resource to, how do we get that to market in the quickest way? And then on the tax credit side, it wasn't all doom and gloom. Right? There were benefits inside of OB3 for energy-related provisions, like the Section 45Q carbon oxide credit, which benefits companies who decarbonize industrial or manufacturing facilities, things like 45Z on the clean fuel production credit, and 45X around advanced manufacturing, which includes critical minerals, which is a hot topic recently, and now includes metallurgical coal. So anytime we have a company who's looking at making investments, and those investments are related to energy security or energy independence, those are the ones that are being prioritized under OB3.
So let's close then by looking ahead. So what's next in energy tax policy, and how should companies be preparing today for those changes?
The next phase of federal energy policy is going to have to recognize and balance the significant and monumental energy needs that are expected. And to address those needs, we're going to need all sources of energy. So with the expected needs, companies, and policy is going to need to focus on energy sources that are reliable, affordable, and available. So what do companies do about that? As you would expect, part of that is making sure that they monitor developments, and for companies with longer term outlooks, making sure we do scenario planning, right? Because we need to stay true to long-term outlooks, especially when it comes from an energy policy perspective, but as we've seen in recent times, be nimble enough to deal with short-term disruptions. And making sure those companies are prepared is of utmost importance.
So on the policy side, anticipating changes, but maybe more importantly, engaging in the process early and often.
Absolutely.
So Greg, thanks for joining us today and for sharing your insights. And thank you for tuning into this episode of Real Tax, Real Insights. Be sure to check back for more conversations with leaders from the EY Center for Tax Policy as we continue breaking down the tax issues businesses are facing today and what's coming next.